The U.S. insurance industry collects $1.7 trillion in premiums every single year, and most people have no idea where that money actually goes. This video breaks down how the machine operates, the real version, not the marketing version. Start with the basic transaction, because everything else builds on it. You hand a company money every month, and in return, they promise you to be paid a much larger sum if something bad happens. The reason this works, the reason insurance companies don't collapse every time a hurricane makes landfall, comes down to a statistical principle called the law of large numbers. Flip a coin once and you have no idea what you'll get, but flip it 1,000,000 times and you'll land near 50% heads every single time. One house fire is unpredictable. 1,000,000 houses spread across 50 states is a math problem, and math problems have answers. The people running those calculations are called actuaries. Before any policy gets priced, they've already analyzed historical loss data, geography, weather patterns, credit scores, and driving records, calculating your specific odds of filing a claim, then building in enough margin to cover claims, operating costs, and profit. That whole process is called underwriting, and it's the first way these companies generate revenue. The industry measures underwriting performance through the combined ratio, total claims paid plus total expenses divided by total premiums collected. Below 100% means profit. Above 100 means they paid out more than they took in. In 2023, the U.S. property and casualty industry posted 101.8%, a loss. By 2024, aggressive rate hikes pulled it back to 96.6%, and the industry returned to profitability. But underwriting profit is not the main event. The main event is what happens to your premium between the moment you pay it and the moment the company cuts you a check, a gap that might be months, years, or for life insurance, decades. During all of that time, the insurance company invests your money. That pool of held premiums has a name, the float. $9 trillion. That's what U.S. insurers held in cash and invested assets by the end of 2024. Warren Buffett described it this way in a Berkshire Hathaway shareholder letter. If our premiums exceed the total of our expenses and eventual losses, we enjoy the use of free money, and better yet, get paid for holding it. Berkshire's insurance operations generate more than $170 billion in investable float. GEICO alone produced an estimated $7.8 billion in underwriting profit in 2024, sitting on top of investment returns earned while holding your premiums. In testimony before the South Carolina legislature, an expert noted that if a large insurer like Berkshire delayed claims payments by a single day, the investment income from that one extra day could reach $12 million. Every day a claim sits unresolved, the insurer earns a return on that money, and no prompt payment law changes the underlying arithmetic. Reinsurance never appears on your policy documents or your premium notices. And yet, without it, the insurance industry stops functioning almost immediately. Reinsurance is insurance for insurance companies. When a major hurricane destroys thousands of homes and hundreds of thousands of claims land simultaneously, no single carrier absorbs that alone without risking insolvency. So insurers transfer portions of their catastrophic risk to a second tier of companies, firms like Swiss Re, that most consumers have never encountered, but that sit behind almost every major policy ever written. In 2024, global natural disasters generated $417 billion in direct economic losses. Insurers covered $154 billion of that, and even that figure only stayed manageable because reinsurance distributed losses across a global risk pool. When reinsurance gets expensive or scarce, that cost flows directly into the premiums policyholders pay, which is exactly what happened in Florida and California. Florida got hit with fast rising reinsurance costs alongside a surge in litigation, and its homeowners insurance market buckled. The state legislature eventually barred attorney fees from becoming part of insurance settlements to reduce lawsuit incentives, but the damage to premiums was already done. Florida's average homeowner's premium stands at $14,140 per year, against a national average of $3,259. California required insurers to price policies using only historical data rather than forward-looking catastrophe models. As wildfire risk climbed faster than history could capture it, multiple major carriers stopped writing new policies in the state entirely. The insurance commissioner eventually changed the rules to allow catastrophe modeling and required carriers to cover high-risk areas in exchange, a forced trade. Between 2018 and 2023, nearly 2 million homeowners policies were canceled nationwide. Insured losses in the United States reached $112.7 billion in 2024, a 36% increase over the prior year. Swiss Re estimated $199 billion in total U.S. disaster losses that year, with only $107 billion covered, meaning nearly half of all disaster-related losses went uninsured. When homes can't be insured, they can't be mortgaged, and U.S. government disaster relief spending exceeded $110 billion in 2024 to fill gaps the private market left behind. At 6:44 a.m. on December 4th, 2024, a masked gunman opened fire on Brian Thompson, CEO of UnitedHealthcare, outside the New York Hilton Midtown. Thompson had arrived for his company's annual investor conference and never made it inside, dying at Roosevelt Hospital at 7:12 a.m. Luigi Magnone, 26, was arrested shortly after and charged with murder and terrorism, pleading not guilty. 3 cartridge cases recovered at the scene carried the words deny, delay, and depose, language echoing a common description of insurer tactics and the title of a 2010 Rutgers law professor book, Delay, Deny, Defend, which argued that major insurers had transformed from safety nets into profit-maximizing entities that systematically avoided paying legitimate claims. A United Health Group Facebook post expressing condolences collected 62,000 reactions, and 57,000 of them were laughing emojis. A NORC at University of Chicago poll found that 8 in 10 Americans held the shooter primarily responsible, but most also said insurance profits and coverage denials shared responsibility for what happened. United Health Group controls 16% of the health insurance enrollment market, the largest share in the country, with 11's Health and CVS's Aetna each holding 12% behind it. These companies generate revenue the same way property insurance do: premiums collected up front, float invested, underwriting margins managed. Health insurance adds one lever property insurance doesn't have, which is the denial of care. Prior authorization, requiring doctors to get insurer approval before certain treatments, exists in principle as a cost control mechanism. A Senate panel report of October 2024 found that UnitedHealthcare's denial rate for post-acute care surged from 10.9% in 2020 to 22.7% in 2022. A 2023 ProPublica investigation found Cigna allowed its doctors to reject claims without opening the patient's file. A 2024 ProPublica and Capital Forum investigation found major insurers using AI algorithms to issue denials, despite evidence those models carried significant flaws. Wendell Potter, a former Cigna executive turned industry whistleblower, put it plainly after the Thompson shooting. "I've been hearing for years from people so frustrated by denials or delays of care, and this was an opportunity for people to vent their anger against someone who just became known to them all of a sudden." And yet, a KFF survey from 2023 found that 81% of insured American adults rated their health insurance as excellent or good. The public's relationship to this industry is genuinely contradictory. Most people are satisfied until they're not, and when they're not, the consequences can be devastating. $1.7 trillion in premiums collected annually, more than 3 million people employed, nearly $9 trillion in invested assets, and close to 60% of the entire global insurance market, all regulated not by the federal government, but 50 separate state systems, a structure locked in place by the McCarran-Ferguson Act of 1945. Benjamin Franklin helped found one of the first successful fire insurance companies in America in 1752, and in its early years, inspectors visited homes to verify they were brick rather than wood and that no trees stood in the front yard because the fire hoses of the day couldn't maneuver around them. The underlying logic hasn't shifted in the 270 years since. Someone assesses the risk, someone holds the money, and someone decides what gets paid. The only question Americans are debating louder than ever is who gets to make that lost call and by what standard.